The Trade is brought to you by Vantage Markets, delivering one of Australia's most trusted and award-winning trading experiences. Explore smart trading at vantagemarkets.com.au.
Hello and welcome to The Trade. Before we get into the charts, a quick look at what traders are watching. And in the US, sales of new single-family homes surged in August, up 20.5%, although the boost from declining mortgage rates is expected to be limited by a weakening labour market. Now, in the latest Fed speak, Mary Daly advocated caution in the easing cycle, saying, quote, moving forward, it is likely that further policy adjustments will be needed as the Fed works to restore price stability while providing needed support to the labour market. We also heard from the Bank of England Governor Mark Bailey signalling further easing, going on to say there's still some further journey down in interest rates to go, but exactly when that will be and how much it will be will depend on the path of inflation going down. Longer dated US Treasury yields did tick up. Shorter dated yields inched lower following comments by Fed Chair Jay Powell pointing to caution around the Fed's next interest rate decision. Meanwhile, Australian three-year government bond yields rose to 3.56%, markets pricing in no chance of the RBA cutting the cash rate at next week's meeting and potentially only one more cut in this easing cycle. Let's get into the charts now and all the technicals with Zoran Kresovic from Blueberry Markets, who joins me now. Great to see you, Zoran. So we touched there on inflation and what the Fed's likely to do. What does all this mean then for the Aussie?
Well, what it means is essentially Aussie has actually sold off quite substantially, or at least a couple of percent from that most recent high or 2.5-year high, which reached 67 cents at the end of August or early September. So essentially what we're seeing is the range-bound trading coming into the effect again. And basically, whilst the Aussie has been actually within that range for quite some time, or at least from last year, it looks like actually we are back to square one. Fed stance on interest rates or further interest rate cuts or monetary easing is actually quite gloomy right now. It seems like actually there is a dual mandate with the inflation, and looks like that some of the inflation, such as labour market unemployment, is actually starting to tick back up. So on those bases, we would probably expect for Aussie to pull back a little bit further, or at least actually to retest that uptrend line in blue dashed line since about April last year, which is actually kind of hovering the trend within the means right now. But nevertheless, we did see actually that in Australia early in the week, the inflation figures or monthly figures have actually come in hotter than what market anticipated at 3%, which is obviously throwing a spanner in the works when it comes to the RBA in interest rate decision next week. Market is all of a sudden turned around and pricing in no interest rate cuts for next week and possibly only one more interest rate cut. And rather than normally, or what was actually priced into the November cut, it might be actually pushed back and we might not get that 25 basis point cut until February next year. On such basis, I would probably expect Aussie dollar to actually start reclaiming some of those losses and potentially coming back to retest the 67 cents, which has been the 2.5-year high recently.
Yeah, really interesting to see, particularly what's happened in the last week or so, those changing dynamics. When it comes to oil, though, you're saying potentially a consolidation, range-bound trading at risk here.
Probably one of my favorite charts, Julia, if I actually, go through everything that's happening in the market right now. And the basis of my decisions are purely on the fact that crude oil has actually somewhat consolidated in a range-bound trading between $62 and $64. We can also see that back in June, or from the highs of $77.59, we've got a blue dashed line, downtrend line, which has been actually broken, and crude extends its gains for the second day, supported by a draw in the US crude stocks. EIA data that showed inventories for the last week fell by approximately 0.6 of a million barrels. and it's essentially defying for forecasts for a modest rise of 0.5 million barrels. So that's actually provided a better demand in the market. Nevertheless, also we've actually got better geopolitical risk at the moment, and we've seen US President Donald Trump escalating rhetoric against Russia during his speech at the UN General Assembly in New York. He's immediately asking for the UN or EU countries to basically stop accumulating and buying the crude oil from Russia, which would dampen the demand or in the market. But nevertheless, at these levels, I actually see crude oil continue to probably head higher. I think the seasonality aspect is an important one as well, Julia. We're actually coming to the end of the summer season in the Northern Hemisphere as well. So crude is probably likely to head higher. I would like to see a break above the $65. If we do break the $65, then in the short interim, we could be seeing a little bit more demand and that next target range of resistance between $67 to $68, at least in the short term.
All right, what about gold though? This is the really big one, isn't it? Is that going to just continue this run? I had a guest yesterday saying there's 10 reasons in his view why gold is surging higher. What's your view, or are we due for a pullback?
Yeah, I probably got 6 to 8 reasons why gold is actually continuing to head higher, and it's probably likely to head higher in the medium to long term. However, within the short interim, we might be expecting a bit of a pullback on gold. At the end of the day, this is a highly extended move, and what I've done is actually all these green lines that I've applied on the chart indicate a price extension move of the last major range when the gold broke out, which was end of August or early September, or off 2nd of September, and we can see the price is actually gone up 100% of an extended range of the prior move, which is actually quite big, especially for such a strong asset and commodity as gold. Gold has appreciated around 42% year to date, making one of the most or best performing assets or commodities globally, not only this year but last year as well. I think it's going to be a lot to do with obviously US Treasury yields as well, and the interest rate forecasts on monetary easing from Fed. If we do, if Fed is actually likely to put interest rate cuts on hold until the end of the year, and we see both the real and nominal 2 and 10 year Treasury yields continue to head higher, then we are probably likely to see a bit of a breather in gold. I would expect probably the price to pull back somewhere around 3,500 to 3,600. I think that is a very, very solid base, but we can't forget that there is also a gap when the breakout did happen at the end of August or early September. So I'm not discounting the fact that gold could potentially come a little bit further down, approximately 10%, to actually retest those levels and then, continue to head higher. But in the medium to long term, I'm still fairly bullish on gold. I have been calling it for quite some time. I think that 4,000 is a major resistance level. It is a nice round number. It's a psychological number. And I think many investment banks have actually projected that gold is likely to head higher in 2025-26, and we are likely probably for those levels to be reached sooner than later.
All right, Zoran, 4,000. We do love a psychological number, don't we? Thank you so much. As always, have a great trading day.
Thank you.
Zoran Kresovic there from Blueberry Markets. That does it for this edition of The Trade. Be sure to join us next time.
The Trade was brought to you by Vantage Markets, delivering one of Australia's most trusted and award-winning trading experiences. Explore smart trading at vantagemarkets.com.au.